$35.7 trillion. That's our national debt, and every politician wants to pay it off. They're wrong, dead wrong, because I'm going to show you how erasing America's debt wouldn't save our economy. It would instantly trigger a $632 trillion financial collapse. A decision in 1971 secretly turned our debt into the foundation of the world's money. This is the debt paradox. You need to know how deep this trap goes. The debt paradox. $35.7 trillion. That's the national debt as of October 2024. Every politician promises fiscal responsibility to pay down our bills, secure our future. It sounds like common sense. But what if I told you they're dangerously misinformed or outright lying? What if paying off this debt wouldn't save our economy but utterly destroy it? This is the debt paradox. The system is inverted. We've built a global financial architecture where reducing this debt wouldn't bring stability. It would trigger a complete, catastrophic collapse. You need to understand how. On August 15, 1971, President Richard Nixon declared temporary economic heresy. He severed the dollar's link to gold. That temporary act, now in its 54th year, its consequences are permanent. The moment Nixon closed that gold window, U.S. Treasury debt stopped being mere government borrowing. It became the very bedrock of money itself. Every dollar, every bank reserve, every global transaction, it all rests on our debt. Now, critics say, debt is debt. It's a burden. Get rid of it. In a simpler world, they'd be right. But that world vanished 54 years ago. Today, paying down our debt is like pulling the foundation from a skyscraper. The global financial system doesn't just tolerate our debt, it requires it. Foreign central banks hold $4.8 trillion in U.S. treasuries, the foundation of their own currencies. Your pension fund, your bank's reserves, even the vast $630 trillion derivatives market, they all depend on a continuous supply of our debt as collateral. Reduce that supply, and you don't just reduce a burden, you liquidate the collateral backing virtually everything in modern finance. The system would seize up overnight. To understand how we got locked in this trap, you have to understand a decision made on a Sunday night in 1971 that turned the entire concept of money upside down. The Golden Handcuffs. The Golden Handcuffs. August 15, 1971. I'm Jordan Blake. I've spent over 10 years researching the mechanics of financial crises and market bubbles. I'm going to be walking you through exactly how this situation impacts your money. And what I'm seeing in our national debt is a structural dependency, a pattern I haven't seen explained clearly enough since the 2008 collapse. President Richard Nixon committed what he called a temporary economic heresy. He severed the dollar's link to gold. That temporary measure, it's now in its 54th year, and it can never be reversed. You need to understand why. The moment Nixon closed that gold window, U.S. Treasury debt stopped being mere government borrowing. It became the foundation of money itself. The dollar, your dollar, changed forever. Picture this: Camp David, Maryland, the tense weekend of August 13th to 15th, 1971. Nixon summons his top economic advisors for an emergency meeting. The atmosphere isn't just tense, it's a full-blown crisis. Treasury Secretary John Connally, famous for his blunt Texas style, lays out numbers that should terrify any American president. Foreign central banks are in full-blown panic mode, draining Fort Knox, demanding physical gold for their dollars. In just the first 7 months of 1971 alone, they demanded $3 billion. Think about that, $3 billion. That's not a trickle, that's a torrent. At that rate, our nation's gold reserves, a meager 281 million ounces, already down sharply from 650 in 1957, would be completely gone within 3 years. What does that mean for you? It means countries around the world were essentially saying they didn't trust our currency anymore. They didn't trust our promises, and they wanted the real stuff backing it. By Sunday evening, Nixon made a decision that would restructure global finance forever. But here's what most people miss. This wasn't some sudden, out-of-the-blue emergency. The cracks had been showing for years. The pressure had been building to an inevitable breaking point. Let's rewind to March 1968, 3 years before Nixon's announcement. The London Gold Pool, established back in 1961 by 8 central banks to maintain gold at $35 per ounce, was hemorrhaging. It lost 1,000 tons of gold in just 3 months. 1,000 tons! Speculators, smart money, around the world sensed weakness in the system, and they attacked. On March 17, 1968, the pool disbanded in what was nothing less than a quiet surrender. Our own Federal Reserve? It had provided nearly 50% of those gold losses, approximately $3 billion worth of our national treasure, flowing out to speculators who correctly bet against us. A two-tier system emerged from the wreckage. Official transactions still happened at $35 per ounce, but private market prices floated above $40. It was a polite fiction everyone knew couldn't last. Then came May 1971, and the dominoes truly started falling. West Germany's Bundesbank, overwhelmed by dollar inflows that threatened to inflate their entire economy, stopped defending the fixed exchange rate on May 5th. Within days, they absorbed $1 billion in unwanted dollars, money they didn't ask for, didn't want, and couldn't get rid of. Switzerland followed on May 10th. Country after country was essentially saying, "We don't want your dollars anymore unless you can prove they're worth something real." The Bretton Woods system, the framework that governed global finance since World War II, was collapsing in real time. Countries were refusing to exchange their goods for dollars they rightly suspected were overvalued. Have you ever wondered why Nixon chose a Sunday night to make his announcement? Because markets were closed. There would be no immediate panic, no rush to dump dollars, no emergency trading. By Monday morning, the deed would be done, and the world would have to accept the new reality. Now, here's where it gets truly unsettling. When Nixon closed the gold window, the Federal Reserve held $11 billion in gold certificates, backing $80 billion in currency and bank reserves. That's already a stretch, right? About $7 in circulation for every dollar's worth of gold backing it. But over the next 3 years, something absolutely remarkable and terrifying happens. By December 1974, just 3 years later, the Fed's balance sheet shows a completely transformed reality. $95 billion in U.S. Treasury securities had replaced gold as the primary asset backing our money. $95 billion. Let me put that in stark perspective. Before 1971, when you held a dollar bill, it was technically an IOU for gold, a promise that you could, in theory, exchange it for something tangible. The Treasury debt itself was backed by the promise of gold redemption. It was a chain of promises that ultimately led to something real. After 1971, the entire system inverts completely. Now, our dollars themselves are backed by Treasury debt. Every dollar in existence has a corresponding Treasury security somewhere in the financial system. Federal Reserve notes are quite literally notes backed by federal debt. Read the fine print on a dollar bill sometime. It doesn't promise gold or silver anymore. It's a promise backed by another promise backed by our government's ability to tax our economy. The national debt didn't just grow larger after 1971. It became structurally necessary to the functioning of money itself. Think about this scenario. You're a foreign central bank in 1972, trying to figure out what to do with the dollars you hold from selling goods to American consumers. Before, you could theoretically exchange them for gold at Fort Knox. Now what? The only safe liquid option is U.S. Treasury securities, our government's debt. But here's the twist. The insidious part of the system, you need those securities not just as an investment, but as the backing for your own currency. When Japan issues yen or Germany issues marks, they need reserves to back that currency. And increasingly, those reserves are our treasury debt. The transformation was complete by the mid-1970s. Our debt stops being something we owe and becomes something the world needs. It's no longer a burden to be minimized. It's the collateral that backs the global reserve currency. Now, the critics will tell you that Nixon thought this was temporary, that he intended to go back to some form of gold backing, or at least a more restrained monetary system. But looking at the cold, hard data, that optimism is mathematically impossible. According to the Federal Reserve's own historical data, this shift was deliberate, systematic. The Fed needed something to replace gold on its balance sheet, and Treasury securities were the only asset large enough and liquid enough to do the job. But this created a feedback loop, a vicious cycle. The more the Fed needed Treasury debt as backing, the more the Treasury needed to issue, the more the Fed needed to buy, creating an ever-expanding cycle that we are still trapped in today. 54 years later, we're not even discussing how to reverse it anymore. We're discussing how to make sure the debt keeps growing fast enough to support the expanding financial system built on top of it. The moment Nixon closed the gold window, he didn't just change monetary policy. He inverted the entire relationship between money and debt. Our national debt transformed from a necessary evil into a necessary foundation. And once that transformation was complete, there was no going back without dismantling everything built since. This wasn't an accident. In the decades that followed, an entire financial skyscraper was deliberately built on this new foundation of debt. I'm going to show you the blueprints. The Collateral Engine. Foundation. The global financial system, a colossal machine, structurally dependent on endless U.S. Treasury debt. It's built in layers. Remove one, it collapses. You must grasp this. The first chain, bank reserves. The Federal Reserve holds $4.8 trillion in treasuries. This debt directly backs $3.4 trillion in bank reserves. Reserves are the bedrock of U.S. banking. Your bank's ability to operate relies on them, backed by our national debt. Reduce debt, shrink reserves, contract money supply, choke lending. The second chain, the repo market. Every night, 4 to 5 trillion in treasuries are required as collateral for overnight loans. This is finance's vital circulatory system. Banks, hedge funds, money market funds rely on this. Without this debt, the repo market seizes, an economy without blood flow. The third chain, international reserves. Foreign central banks hold $4.8 trillion in U.S. treasuries, not investments. These are the essential monetary base for their currencies, yen, yuan, and collateral for international trade. Our debt backs their money. Remove treasuries, destabilize foreign systems, trigger global currency chaos. The fourth chain, derivatives collateral. The global derivatives market, $632 trillion in notional value, relies on U.S. treasuries as the preferred risk-free collateral. Derivatives manage global business risk. Without continuous debt supply, this $632 trillion market seizes overnight. Companies can't hedge. Global trade falters. Your mortgage, imported goods, all impacted. Now, some call this prudent regulation. Global rules, like Basel Accords, give U.S. Treasuries 0% risk weighting, zero capital cushion, no accident. This design created structural dependence. Our debt isn't tolerated, it's the indispensable foundation. Every crisis since 1971 forced more treasury issuance. Debt grows because the machine requires it. They didn't just build the machine, they designed it so that every financial crisis only makes it bigger and more dependent on debt. Here's what happened the last time the machine started to break. The feedback loop of failure. Failure. That is the only word you need to understand when we talk about the U.S. national debt. Not burden, not problem, failure. Because in the modern system, reducing our debt, or even just disrupting its supply, doesn't prevent a crisis, it causes one. And the government is then forced to issue more debt just to keep the entire structure from collapsing. It's a terrifying, inescapable feedback loop. Look at March 10, 2023. Silicon Valley Bank fails. A financial earthquake. Now, what do you think caused it? Reckless loans to startups? Mismanagement? Fraud? No. SVB failed because its $80 billion portfolio of U.S. Treasury securities and mortgage-backed securities, purchased when rates were low, became illiquid. When the Federal Reserve hiked rates from 0.25% to 5% in a year, those supposedly safe Treasury holdings lost $15 billion in market value. The bank couldn't sell them fast enough to meet depositor withdrawals without taking a catastrophic loss. Think about that for a second. The bank that did everything it was told, held the safest assets, the ones regulators give a 0% risk weighting, that bank collapsed. Why? Because even treasuries, the ultimate safe haven, became illiquid when the market got stressed. It wasn't about price, it was about liquidity. The collateral, the very foundation of the bank's balance sheet, ceased to be freely available when it was needed most. Within days, First Republic Bank, with $23 billion in assets, and Signature Bank, with $110 billion, also faced bank runs. The system was on the brink. Here's the paradox, and this is what you need to understand. If we were to reduce Treasury issuance to pay down the national debt, we would be artificially shrinking the supply of this crucial collateral. We wouldn't be preventing future SVB-style crashes, we'd be guaranteeing them. We wouldn't be causing a price crisis, no, we'd be causing an utter liquidity crisis, because the banks, the money market funds, the entire financial ecosystem simply wouldn't have enough collateral to satisfy legal requirements, let alone market demands. Same crash, different cause. Now, the critics will say, Jordan, these are just isolated incidents, banks taking on too much interest rate risk. It's not a systemic issue with the debt itself. But that argument crumbles when you examine the market's insatiable hunger for this very same debt. Let's fast forward to September 2023. The Federal Reserve's overnight reverse repo facility, a place where institutions park cash overnight using treasuries as collateral, saw its balances plummet from $2.6 trillion in December 2022 to $1.2 trillion by September. Financial journalists, bless their hearts, reported this as money simply leaving the Fed. But what was really happening? It was a treasury shortage. Institutions weren't just moving cash, they desperately needed to hold actual treasury securities rather than lend them back to the Fed overnight, because there simply weren't enough treasuries available in the broader market to meet demand. What did the U.S. Treasury Department do in response? Did they say, great, let's slow down borrowing? No, they announced $1 trillion in new borrowing for the fourth quarter of 2023. And get this, it wasn't primarily to fund new government spending. It was explicitly to provide more collateral to the financial markets. The government borrowed $1 trillion, not because it needed the money for programs, but because the global financial system needed the collateral. The debt increased to stabilize the system, not to fund new entitlements. This is the feedback loop in action. Market stress creates demand for safe collateral, forcing more debt issuance. And the market's addiction to this debt, it's undeniable. Let's look at October 2024. The U.S. national debt reached an eye-watering $35.7 trillion. By any historical standard, this should signal crisis, panic, spiking interest rates as the world loses confidence in America's ability to repay, right? Wrong. Instead, this milestone was met with record-low Treasury yields on 10-year notes, hovering around 3.8% and overwhelming demand at auctions. Consider the auction on October 9, 2024. $42 billion in 10-year notes were offered. The bid-to-cover ratio was 2.67, meaning there were $112 billion in bids for only $42 billion in bonds available. Investors weren't just willing to lend us money, they were fighting over it, accepting rates that barely covered inflation. Foreign central banks currently hold $8.1 trillion in our debt, with Japan holding $1.13 trillion, China $775 billion, and the United Kingdom $750 billion. These aren't casual investments. These are the foundational reserves for their own currencies, the collateral for their international trade. The market isn't worried about too much debt. It's positioned for more debt. It demands more debt, and it would actually panic if debt issuance slowed significantly. Think about the $6.7 trillion managed by U.S. money market funds as of November 2024. These funds, where millions of Americans park their savings, are legally required by SEC rules to hold at least 10% in daily liquid assets and 30% in weekly liquid assets, primarily Treasury securities and repo backed by Treasuries. The entire money market industry, fundamentally, legally, requires a continuous supply of Treasury debt just to function. If we paid down the debt, we would literally force these funds into regulatory violation, collapsing a cornerstone of American savings. You see the pattern now, don't you? Every crisis, every tremor in the financial system triggers a desperate scramble for liquidity, for collateral, and the only asset abundant enough, liquid enough, and universally accepted enough to plug the holes is U.S. Treasury debt. This creates a terrifying feedback loop. Market stress creates a demand for more safe collateral, treasuries, which forces the government to issue more debt, which makes the system even more dependent on that continuous supply. So if the system is designed to grow forever, who profits from this inescapable cycle? And more importantly, who gets the final bill? The answer is in your bank account, and it's not what you think. The final invoice. The scales have tipped. We've journeyed through 50 years of deliberate construction, revealing a financial system built not despite debt, but on it. Now for the final invoice. Who profits and who pays the ultimate price? Look at this. The winners are clear, illuminated by the relentless pursuit of profit within this debt-based architecture. First, the primary dealers, the titans of Wall Street, like JP Morgan Chase, Goldman Sachs, Bank of America Securities. These aren't just banks, they are the mandated architects of our debt, obligated by the Federal Reserve Bank of New York to bid at Treasury auctions. They earn bid-ask spreads on a staggering $640 billion in daily Treasury trading volume. Think about that. Every single day, over $500 billion flows through their hands, extracting fees from the very system our government depends on. JP Morgan alone reported $2.1 billion in fixed income trading revenue for Q3 2024, heavily weighted towards government securities. This isn't just business, it's a government-mandated franchise to profit from the national debt. Next, the money center banks. They hold $1.22 trillion in Treasury securities on their books, not just as investments, but as regulatory gold. Why? Because the Basel Committee on Banking Supervision, through Basel I, II, and III, granted U.S. Treasury securities a 0% risk weighting. You need zero capital cushion to hold them, unlike corporate bonds. This makes our government's debt the safest, most desirable asset for banks worldwide, simultaneously satisfying compliance and generating returns. They get to hold assets the government is compelled to issue with no risk capital required. It's a license to print money backed by our liabilities. And let's not forget the Federal Reserve itself, holding $4.8 trillion treasuries, using that interest to fund its operations and dictate monetary policy. Foreign central banks, from Japan to the UK, hold $4.8 trillion in U.S. treasuries as the bedrock for their own currencies and global trade. They need our debt to back their money. The question isn't whether they trust us, it's whether they can function without us constantly borrowing. But here's the grim reality for you, the American citizen. Here's who loses. The most glaring cost? The interest invoice. Future taxpayers, our children, our grandchildren, are on the hook for a crushing $879 billion in annual interest payments on the national debt for fiscal year 2024 alone. That's up from $352 billion just 3 years ago in 2021. The Congressional Budget Office, not some fringe analyst, projects these interest costs will soar past $1.6 trillion annually by 2034, consuming 3.6% of our entire GDP. That's money that can't be spent on schools, roads, healthcare, or defense. It's a dead weight, sucked into the system to service debt, not to build a better future. It's a silent, structural tax levied directly on your potential. Then there's the even more insidious cost, the hidden tax. This is the slow, relentless erosion of your purchasing power. Dollar savers, retirees on fixed incomes, anyone who believes in the value of their hard-earned money, you are being bled dry. This debt money system, engineered to expand, guarantees currency debasement. Look at this chart. According to the Bureau of Labor Statistics' own inflation calculator, the $1 you held in 1971 now requires $7.47 just to buy the same goods. Your savings, your salary, your fixed pension, all declining in real value to feed this beast. Your future is being stolen, dollar by dollar, to prop up a system that benefits those closest to the money spigot. Main Street businesses and individuals, the very backbone of our economy, bear the full weight of inflation and taxation without access to the profit-generating mechanisms Wall Street enjoys. For us, debt is a burden. For them, it's a goldmine. Now, I hear the critics already. Jordan, they'll say, this is just basic economics. We need to cut spending, balance the budget, and pay off the national debt, just like any responsible household. You need to understand, this isn't a household budget. That common wisdom, that call to fiscal prudence, is a dangerous fantasy. If we actually tried to pay off this debt, if the Treasury Department suddenly stopped issuing new bonds, the entire financial system, the one built over 50 years, the one we just dissected, would collapse overnight. Think about it. 1. The Federal Reserve's $4.8 trillion balance sheet, which backs our bank reserves, would shrink. Banks would be forced to contract lending. Money supply would vanish. 2. The $4 to $5 trillion repo market, the very circulatory system of finance, would face a catastrophic collateral shortage. Overnight lending would seize up. Banks would fail. 3. Foreign central banks, whose $4.8 trillion in U.S. treasuries back their own currencies, would plunge into chaos. 4. The $632 trillion derivatives market, essential for global trade and risk hedging, would choke on a lack of collateral. Your mortgage rate, your company's borrowing costs, the price of imported goods, all would spike. This isn't about political will, it's about structural necessity. The system doesn't tolerate perpetual debt, it requires it. The goal then isn't for us to pay off the debt, because that is an impossibility without detonating the global economy. The goal for you, as an individual, is to understand this rigged game and to position your wealth outside the direct path of its relentless currency debasement. Protect yourself. The next time you hear a politician promise to pay off the debt, you'll know the truth. They're not offering a solution. They're threatening to detonate the entire system. The math doesn't lie.